Hello, everyone. I hope you're all good and you're staying healthy. So before starting the lecture, I would like to make an announcement concerning the final exam that we are going to have it. So before the final exam, we'll have one more chapter, which is dividend and share repurchases analysis. This will be the last chapter that we're going to cover. And what will be included in the final exam? The cost of capital, only one example from the cost of capital, which is page 172. So I would ask you to go through that example. We already did, but I will ask you again to go through before the exam. Just try to see that question. Measure of the leverage, dividends and share repurchase basics, and the dividend share repurchase analysis. These chapters, these lectures will be included in the final exam. The date of the final exam is 26th of April, which is 12 days or 13 days from now. It is on Monday, and it's Monday at 7 p.m. The timing will be not that much. It will not take a lot of time from you. It will be a multiple choice. There will be 5 multiple choice questions, and it may take from you actually maybe up to 30-45 minutes maximum to solve those questions. So this is the exam that I wanted to announce. So everybody should attend it. And if you have any questions, please feel free to ask. And assessment 3 is 40 points, which is consisting of 10 points of the activity. Attendance is 5%, and 25% is the exam. So each question will weight like 5 points that you're going to have it. And what else I wanted to tell? The lecture notes are all available here. The measure of the leverage. The capital structure is not included, and the cost of capital itself, but in the cost of capital, you're responsible only for one specific part. For one example, just you have to study that. So what you will need to study is the measure of the leverage, dividend share repurchase basics, and dividend share repurchase analysis. This is what you need to study. Okay. Okay, if you have any questions, please feel free to ask. If not, I will take the attendance. And in that way, we'll just continue. Okay. Lutfia?
I'm here.
Okay. Aynur?
I'm here.
Ajar, do you want to ask something?
Yes, I have a question. So in student portal shows that the final exam is 6 May, so you have changed the date to 26th of April, right?
Yeah, that's very true. That's very true. Thank you for clarification. We don't have any final exam on the 6th of May. We will have it on Monday, 26th of April. So
thank you.
And actually there isn't much to study. The information is not that too much. The time will be more than enough to study that. And from today, I'll finish the lecture. And after that, every time we meet, we're going to practice the questions. Like we're going to solve the end of the chapter questions all together. I'm going to solve it and explain one by one all the questions so that you don't have any clue or any questions regarding to any problem that you're solving. Okay. Inkar? Inkar,
I'm here.
Here. Aygul, Besikesh.
I'm here.
Okay. Nuray, Bolat.
I'm here.
Madina.
I'm here.
Dilnas.
I'm here.
Tamerlan. Muhammad Ismail.
I'm here.
Aida.
I'm here.
Okay. Aynur.
I'm here.
Leila.
I'm here.
Irlan.
Present, Professor. Yeah.
Okay. Aygul. Mahmutawa. Evgenia.
I'm here.
Madina.
I'm here.
Adina.
I'm here.
Chingiz.
Here.
Okay. Dalida.
Here.
Daniar?
He have troubles with microphone, Professor.
Okay, I can see. Thank you so much. Okay, Alina is here. Alina? Okay, Alina is not here. Tursunbay? Tursunbay? If you cannot raise your voice, or if you have any problem with the mic, please write down in the chat. Dimash, Iksan, are you trying to say something, because I don't get you?
I'm here.
Tursunbay is here. Okay. Adiler?
Here.
Abdualim, he was here. Daurian? Okay. Begzat?
I'm here, Professor.
Okay. Adilet?
Here, Professor.
Here.
Daurian, you're here. Okay, I see it. Ajar? She was here.
I'm here.
Okay. Ramila?
I'm here.
Amirjan? Adilbek?
I'm here.
Dil Muhammad Iksan?
I'm here.
Okay. Mihriyay?
I'm here.
Okay, great. Okay, let's continue with the course. So today we're going to go over the dividend and share repurchase analysis. So basically, the payout policy is the principle regarding the corporation's distribution to the shareholders. May be established with regard to a dividend payout, dividend per share, the growth in dividend per share, or any other metric. And it may include stock split, stock dividends. It may also include stock repurchases. So payout policy does not only mean that paying the dividend in cash. And as we remember from the previous course, dividend is paid in different forms, in cash and in non-cash forms. Like non-cash forms are stock split, stock dividends, and so on. But payout policy in cash forms are the cash dividend and the stock repurchases, and so on. Like homemade dividends, and it may just has an endless list. And the more general one, the more popular one are listed in the slide here. So the dividend policy that the company value, the theory, are listed here. We have dividends are irrelevant, bird in the hand, tax aversion theory, and the other like clientele effect, signaling, and agency cost effects. So these theories have some impact on the payout policy, have some impact on the potential shareholders who's planning or who will purchase a certain stocks of the certain company. So we'll just go through this theory, like dividends are irrelevant, bird in the hands, the tax aversion theory, and the other one like clientele effect and signaling or agency cost. Talking about when the dividends are irrelevant theory, in accordance with the Miller's and Modigliani proposition, the world with the no taxes, no transaction cost, with the homogeneous information, dividend policy actually does not impact the value of the company. For example, if an investor would like to have a cash flow where he or she could sell some shares, homemade dividends, this may not affect any, what do you call it, the value of the company, any transaction that may take within this range. If an investor would like to have a stock and that he would like to use the dividends to buy some shares, basically the bottom line in here, the dividends policy, especially in the terms of the paying out the dividends, like cash dividends, does not impact the firm's value, the firm's equity value. So they're in different position. When it comes to the bird in the hand argument, the investors actually here prefer the cash dividend to uncertain capital gains. So there are types of investor who prefer the bird in hand. Like they say, I should have a bird in hand rather than just having nothing in the future. I cannot bet for my money for the future, like whether the stock can appreciate or can depreciate. So I will have I will buy the stock with the preference I will receive the like higher dividends. So I'm not planning to get any money, earn any money on the stock appreciation. So I will buy in case if it pays the dividend. As we know from the example from the previous class that we have passed through and that I gave you the activity as well, there are some companies that they don't pay any dividends. So this type of investor, they will not go and buy such stock from this type of companies. So the explanation holds, and the company that pays the cash dividend will have a higher value than the similar company that doesn't pay any cash dividend. So dividend policy in here, it has an impact on the value of the firm. The tax argument: if the dividends are taxed at a rate higher than the capital gains, investors, they prefer the companies reinvesting the cash flow back to the firm. So in other words, the investor would like to have the cash dividend paid instead of receiving some appreciation in the stock, because if we assume that the tax rate that are paid in the dividends are lower, but if the tax rate are higher in this case, then the investors will prefer to have those capital gains that they will get from the stock appreciation, and they pay the tax on it. So these are the case as zero dividend payout when the dividends are taxed at a higher rate than of the capital gains. So bottom line in here, dividend policy has got some impact on the value of the firm. So we have dividend are irrelevant theory, where it doesn't get any influence. It does not influence the value of the firm. The second theory, bird in the hand, which means that the investors are preferring the cash dividends against any potential capital gain that they may receive from the appreciation, because appreciation is not certain, and it may go in opposite direction, like depreciation. So you will not get any gain, but you will get a capital loss. So this type of investor, they say we should have a bird in hand. So the issue in here is the riskiness of the stock appreciation. So the dividend policy has got some impact. And the third theory is a tax argument. If the dividends cash has got the higher tax rate than the capital gains, then the investor, they prefer to get the capital gains. They prefer to buy the stocks which has got lower dividend payment. Or if the dividends are taxed at lower rate in contrast to the capital gains, then the investor, they are preferring to get higher of cash dividends oriented stocks than just waiting for a stock appreciation. So the bottom line in here as well, the dividend policy exerts an impact on the value of the firm. The fourth theory is the clientele effect, is the influence of the group of investors that are attracted to companies with a specific dividend policies. Okay, like clientele are simply the group of investors who has got some preferences, and these preferences are more or less the same. So these are, for example, what are the types of the clientele? Like, first of all, if an investor has a marginal tax on capital gains lower than the marginal tax on the dividends, so investor will prefer the return on in the form of capital gains. There are second types of investor who are tax exempt, like those investment types are pension funds, are indifferent about dividends and the capital gains. And some investors, by policy or restrictions, only invest in stocks and that pay the dividends. So there are some investors cannot invest in a company or in a stocks or shares which doesn't pay the dividend. So they only invest in a stock that pay only the dividends. So there are some restrictions they could have it. The importance of the existence of the clientele is the investor will have a preference for stock with a specific dividend policy characteristics. So bottom line in here, the clientele effect does not necessarily imply that dividends have value on the equity, on the net worth of the company. So it may have, it may not have. It will depend on the types of customer or types of investors. There's another theory which is dividend signaling. Under MM proposition theory, everyone has the same information, and when there is asymmetric information, dividend changes may convey the following information. It may provide you positive information in the sense of when the dividend has initiated payments for certain company, like there's a, let's say, Facebook, they have not paid so far, but they have said and they have announced that they are going to pay the dividends. This is called the dividend initiation. Like for the first time, they pay the dividend. Or they're another company that pays the regular dividends. However, they have decided to pay dividend higher than in contrast to the last year, which announced the dividend increase. So keeping under assumption that all the investors has got the same information, homogeneous information. Positive information can be conveyed through dividend initiation and dividend increase, but negative information can be derived through the dividend omissions or dividend reductions. And there's another theory which is very important as well, like agency cost, and everybody is knowing, is assumed to know like what is the agency cost. It's a cost that arises between the owners and the managers of the company, where this ownership is separated. There's always a conflict of interest between the managers and the shareholders. So management may invest in a negative NPV projects that will enhance the company's size and the management's control. However, it will not be in the favor of the shareholders. That will conflict of the interest of the shareholders. So it will create some disagreements between the managers and the shareholders. On the other side, having the free cash flow tempts management to make investment that are not positive NPV. Paying dividends uses this free cash flow, kind of improves these conflicts, like solves out this conflict. Like rather than leaving the money in the company's budget, let's pay out the dividends. This is what the shareholders may decide in order to impact the agency cost, to reduce the agency cost. So bottom line in here, dividends may reduce the agency cost, and therefore it may eventually increase the value of the firm. And let's go through factors that are affecting the dividend policy. There are factors that affect like investment opportunities, financial flexibility, floatation costs, expected volatility in the future earnings, tax consideration, and contractual and the legal restrictions. So talking about the investment opportunities, a company with more investment opportunities will pay out less in dividends. A company with a fewer investment opportunity will pay out more dividends. Talking about the second factor, which is expected volatility of the future earnings, companies with a greater earnings volatility are less likely to increase the dividends or a greater chance of not maintaining the increased dividends. When it comes to the financial flexibility, the companies who seek for more flexibility in terms of liquidity position, they are less likely to pay the dividends or to increase the dividends because they would like to preserve the cash, or they may go through the stock repurchase plan to keep stable the liquidity position of the company. Tax consideration, the tax rate on the dividends and how the dividends are taxed relative to the capital gains affects the investor preferences and hence the company's dividend policies. The flotation costs, these costs that may make it more expensive to use newly issued stocks instead of internally generated funds. So when the company issues stocks or any preferred shares or any securities, it is the cost incurred by the company. So the higher this cost, it will make more expensive to newly issued stocks. So the higher the flotation cost, the lower will be dividend payout. So given need for equity capital in a positive NPV projects. And contractual and legal restriction of the factor that affect the dividend policy, companies may be restricted from paying the dividends. Impairment of the capital rule, like dividends paid cannot be excess of the retained earnings. Debts, like in here, it is meaning that if your retained earnings, let's say $100 million, and your dividend cannot exceed this $100 million. So if you're planning to pay the dividend, either it's a cash form or non-cash form, it should not be more than retained earning if there is a impairment of the capital rule. Debt covenants are designed to protect the interest providers of the debt capital. If you remember from accounting course, when the company goes into failure, like when the company is bankrupted, the first people who are prioritized in terms of getting the compensated are the creditors, then the governmental bodies, and then if anything left after the suppliers, if anything left, the shareholders. So some debt covenants, like we're talking about the creditors, may put an obligation to protect the interest providers of the debt capital. The companies are required to meet or exceed the target for liquidity or coverage ratio before they can pay the dividend. So they put some coverage ratio so that it cannot be more than, let's say, this amount. And if they satisfy it, then if anything left above it, they can pay it. If not, they have to just satisfy this liquidity position. And there could be some requirement for the preferred shares. The price change, dividends, and the tax rate. So price change is equal to dividend multiplied that 1 minus tax on dividend and over 1 minus tax on capital gain. So PB means the price before the dividends paid, and PA means the price after dividends paid. So this is the price change. So the price change is equal to the dividend, which is taxed through tax dividend and through capital tax, capital gain tax. So when we have some examples at the end of the chapter, we'll get into more of these things. There is effective tax rate issue that shows in reality how much tax is paid, like tax for the corporate basis and tax for the individual tax rates. So the tax system and dividend policy, they consider the company that has got earnings before the tax of 100 million and pays all its earnings as dividend, and the company's tax rate is 35%. Individual shareholders have the marginal tax at 25%, and in countries with a split rate system, dividends are taxed at 28% at a corporate level. So in here, talking about the double taxation system, earning tax at corporate level first, and then in dividend tax at the shareholder level. So if you remember, net income is divided into dividend and the additional amount to the retained earnings. So before coming to this net income, the earnings, like earnings before interest and tax, is taxed at the corporate level, and then they are paying the dividends. And the dividends, the owners of the company, they receive the dividends, and these dividends, when they receive it, it will be taxed as well. So effective tax on the dividends, I mean, how much in reality they pay the tax amount is here we go. So we just put into formula and we get like 51.25%. Like corporate tax and the marginal tax rate on the shareholders, individual marginal tax rate, corporate tax. We just substitute the numbers and we get it. Dividend imputation, it's an earnings tax at the corporate level and the tax credit at the shareholder level. Like there's sometimes it can be the case that the government gives you the subsidy, refunding you back the money. Like we have $100 million of earnings on hand, and which will make us $25 million to pay the tax. Applying what the corporation paid is actually $35. Okay, the corporation paid. We said the corporate level tax is 35% out of 100, so which means they will pay $35 million. However, on a shareholder level, they pay 25%, which makes 25 million. So $10 per share or $10 million of dollars will be refunded back in accordance with the dividend imputation. When it comes to the split rate system, earnings distributed are taxed at a lower rate than the retained earnings. So effective tax on the dividends will be 46%. Like 28% is dividends are taxed when you distribute it. Plus you tax it again, 1 minus, you're using this formulation. And you're multiplying with the individual tax, which is 0.25%, and you get the effective tax on the dividend. In reality, how much you pay the tax rate on the dividends. However, if you want to get more clarification about the effective tax rate and in what is the logic behind the terminology, you can compare what do you call it, effective annual rate versus APR. Does anyone remember what was the effective annual rate? Effective annual rate, it shows you how much of the interest rate is paid in reality than it has been stated. So whenever you go any bank, they state you APR. Okay, they state you APR, like annual percentage rate of 12%. But in reality, you don't pay the 12%, but you pay more than 12% due to the nature of the interest rate system, because the interest rate is paid interest on interest. Like it has got the compounding effect. So that's why the effective annual rate is always higher than the APR. And when you get a loan from the bank, you don't pay the APR, you pay the effective annual rate. So in here, we're trying to show you that how much you pay the effective tax rate on dividend, effective tax rate generally, and so on. Okay. Stable dividend payout policy. It's a constant dividend with the occasional dividend increases. Okay. Increase may represent an adjustment to a target payout ratio. In theory, in accordance with the Jones-Litner's, the company may adjust to a target using an adjustment factor that is less than or equal to 1. So dividend basically is equal to previous dividend that you had paid plus increase in earnings times the target payout ratio and times adjustment factor. So basically these three factors, these three variables are representing the increase in dividend, by how much the dividend will increase for the current year. So for constant dividend payout ratio, it's uncommon, but for the stable dividend policy, it's a common thing. And we have on the other side, we have a residual dividend payout. So they pay out the earnings remaining after the capital expenditure. So we're gonna go through each case separately. So consider the financial information for the Apple Incorporation is given, like 2012, 2011, 2010, net income, the earnings, okay. What is the increase in the dividends for 2011 and for 2012? If the company followed a stable dividend policy, okay, if we follow the stable dividend policy. So we can use this formula and we cannot use it in constant dividend payout policy. But for the stable dividend policy, we can use it. So we can see that target dividend payout is 10% and adjustment factor is 0.3. So first of all, what is the increase in earnings in 2012 and 2011? In 2012, the increase in the earnings, we can see that from 2011 to 2012, the earnings increased by 15,000. And from 2010 to 2011, the earnings increased by 11,900. Then we have a target ratio dividend ratio, it's 10%. And we have adjustment factor. We just apply this into formula, and in this way we'll be able to find increase in dividend. So increase in earnings here, multiply by target ratio of dividend, and multiply by adjustment factor. And we get increase in dividend in 2012, increase in dividend 2011. This is how much, by how much dividend will increase in certain years if stable dividend policy employed. But what if we're following the constant dividend payout at 6%? Okay, we're following constant dividend payout. So as we said, this formula, the previously that I have mentioned, is not applicable in here. So in here, we'll just multiply by 6% of adjustment factor. So in 2012, the net income or earnings was 41,000, and 2011 it was 25,000. Then we multiply and we can see by how much the dividend increased if constant dividend payout policy was employed instead of stable dividend payout policy. What if the dividend company is following the residual payout policy? So if you remember from the definition, the residual, in order to estimate the increase in the dividend, we need to subtract from the earnings the capital expenditures. So net income minus capital expenditure will give you the increase in the dividend. Earnings minus capital expenditure will end up with the dividend payment increase in accordance with the residual payout policy if it was employed. Okay, we can evaluate the safety of the dividend by examining the company's ability to meet its dividends. Safety actually means in here the ability of the company to continue to pay the dividend or maintain a growth of that paying dividend. A possible ratio that could be used in here are dividend coverage ratio and the free cash flow coverage. Using the dividend plus the repurchase may be more appropriate for some firms. And basically the benchmark that has been used in here to understand whether the company is in a safe position, whether the company is capable to pay its dividend or maintain its growth pattern, the value should be greater than 1. However, it's a just theory benchmark, but this benchmark might change from industry to industry, from country to country. So there's some certain industry. Okay, we should look into the industry average, but basically in theory, like a liquidity position, it is believed that if it's more than 1, it shows the ability that the company is capable to meet dividend and the repurchases. And all the greater the coverage, the greater the liquidity and the ability to pay. So it is sometimes difficult to predict the changes in the dividend because of the surprises that the company may face. Like the example we can give, currency depreciation, the currency devaluation, like in Kazakhstan and Russia that took place in 2014. The national currency devaluated unpredictably and it lost its value. Or global financial crisis that took place in 2007, 2009. These are the surprises that we're talking about. So let's talk about the dividend coverage ratio. Dividend coverage ratio is the net dividend, or so net income over the dividends. It includes not only the cash dividends, it includes non-cash dividends as well. It can include all the forms of the dividends are included in this dividend. Company has got 200 million in earnings, pays 40 million in dividend, and has a cash flow from operation 180 million, and had a capital expenditure of 60 million. The company spent 10 million for the share repurchases. So dividend coverage ratio is 200 million of earnings divided by 50. Why 50? 40 plus 10. It gives you actually the total amount of dividend is equal to not 5, but it's 4 actually. Right? It's 4 times. Okay, so it's a 4, which is bigger than 1. So we can say the company is really in a safe position. It's a liquid. They have a capability to pay their dividends and maintain some dividend growth patterns. And free cash flows coverage ratio is here, where from cash flow from operation minus capital expenditure and divided by all overall dividend. It's 4.4 times. So this thing as well is measuring the capability or ability of the company to meet its dividend payment. So this is straightforward formulas. And global trends in here that gives you some facts about the companies. Like large and profitable companies tend to have a stable payout policy. Smaller and less profitable companies tend to not to be dividend paying. And in developing companies, like fewer companies pay cash dividend, but more companies are using the stock repurchases. The dividend amounts and payouts have increased for dividend paying companies, but proportion of dividend paying companies basically declined. These are the facts that are driven out from the market. So I'm done for this. This chapter is very short. So I would like you to apply some theory on the practice and give you some activity, and it will be the last activity in this course. It will be activity 12, which I'll create it now here for your group. So what you will do basically in activity 12, you will select the companies and estimate the dividend coverage ratio, and what will be your decision on the results, and which company would you buy. If you think that you're put the condition that you will buy the stock or shares if the company pays the dividend. This is the condition that you should keep in mind. And the deadline, I'm going to put it before the class ends. Today is 13th of April. We have got more than enough time to do it. So you're going to find 3 companies and you're going to estimate dividend coverage ratio. And I can give you, it's better to type it rather than submitting, just type it, okay? I will give you a restriction on the access. It's group number 1. So you've got 35 minutes to do it. It's more than enough time. And what do you need to do? If you have any question, please feel free to ask now. As I told you, it's the last activity in this course. We'll not have any more activity. If you have any question regarding the chapter, please feel free to ask. If not, go to Yahoo Finance database or any other database where you can search actually the companies, publicly listed companies, and from the income statement, you can calculate the dividend cash coverage ratio. So select any companies. Let's say here I can select any of them. Microsoft, Pepsi. 3 different companies from any industry. So if you have any questions, feel free to ask.